In March 2024, Brookfield Asset Management walked away from $2 billion worth of office towers in Los Angeles. They didn't sell them. They didn't restructure the loans. They just stopped paying. And the banks that held those mortgages, they're now stuck with buildings worth 40% less than the loans. But here's what nobody's telling you. Brookfield isn't special. They're not uniquely incompetent. They're just early. Right now, in 2025, there is $2.1 trillion in commercial real estate loans coming due between now and 2027. Most of these loans were made when interest rates were 3%. They have to refinance at 7% to 9%. That's triple the cost for buildings that are now worth half as much. The math doesn't work. And when the math doesn't work, defaults happen. Not in theory. In reality, I'm going to show you 3 things in the next 30 minutes. First, the exact mechanism of how this collapse works. Why it's not just possible, it's inevitable. Second, which banks are most exposed, where your money is at risk right now. And third, what happens when $2 trillion in commercial real estate loans default? Because it's not just about buildings, it's about banks, pensions, and the entire financial system. In 2008, the crisis started with $1 trillion in bad mortgages. This is twice that size. And it's already started. Let me explain. Let me show you why this isn't speculation. It's arithmetic. A commercial real estate loan works like this. A building owner borrows money to buy or refinance a property. The loan is typically 5 to 10 years. When it matures, they have 2 options. Pay it off in full or refinance. Almost nobody pays off $1 billion loan in cash. So they refinance. Now, here's the problem. From 2010 to 2021, interest rates were historically low. Commercial real estate loans were made at 3% to 4% interest. Building owners could afford these payments. Banks were happy to lend. The system worked. Then 2022 happened. The Federal Reserve raised interest rates faster than at any time in 40 years, from 0 to 5.5% in 18 months. Commercial real estate loans now cost 7% to 9% to refinance. Let me show you what this means in real numbers. A building owner has a $100 million loan at 3% interest. Their annual payment is $3 million. That loan matures in 2025. They need to refinance. The new rate is 8%. Their new annual payment is $8 million. That's not 8% more. That's 167% more. Can the building generate $5 million more in rent to cover the higher payment? No, because we haven't even gotten to the second problem yet. Occupancy. During Sauve Day, companies realized something. Most office workers don't need to be in the office 5 days a week. Work from home became permanent for millions of jobs. Office occupancy rates collapsed. In major cities, 40% to 50% of office space is now vacant. San Francisco, 36% vacancy rate. Houston, 27% vacancy. New York, 22% vacancy. When half your building is empty, rental income falls by half. So now our building owner has a problem. Revenue down 40%, interest payments up 167%. Stay with me because this is where it gets worse. When revenue falls and costs rise, the building's value collapses. Commercial real estate is valued based on something called net operating income divided by cap rate. You don't need to understand the formula. You just need to understand the result. When rental income falls and interest rates rise, property values drop 40% to 60%. To our $100 million building, it's now worth $50 million. But the loan is still $100 million. The building is underwater. The owner can refinance because no bank will lend $100 million on a property worth $50 million. So what does the owner do? They walk away, just like Brookfield did. There's a financial storm brewing, and it's not on Wall Street, at least not in the way you think. It's happened in plain sight, in the empty office buildings, in quiet shopping centers in your own city. This is the story of the commercial real estate crisis, and why it might be the trigger for the next major financial event. Is cheeky with me, because what I'm about to show you affects everyone, not just big shot investors. Let's start with a simple scenario. Imagine a developer borrows $100 million to build a shiny new office tower. But now, post-pandemic, with remote work being the new norm, They can't find enough tenants. The building's value plummets to $50 million. When the loan comes due, the developer can't pay it back. So they do what's called a strategic default. They hand the keys to the bank and walk away. Now, the bank is stuck with a $50 million building and a $100 million loan on its books. That's a $50 million loss. Sounds bad, right? Well, now multiply that. Over the next 3 years, a staggering $2.1 trillion in commercial real estate loans are coming due. Even if only 20% of those default, we're looking at $420 billion in losses. That's a number big enough to shake the entire financial system. But here's the crucial part that nobody is talking about. Who is holding these loans? Not all banks are created equal in this crisis. The giants, like JP Morgan Chase, Bank of America, Wells Fargo, they have exposure to commercial real estate, sure, but it's a relatively small slice of their overall business, maybe 5 to 10% of their total loans. They're diversified, they have mortgages, credit cards, auto loans, you name it. If their commercial real estate loans go bad, they'll feel the pain, but they'll survive. They won't collapse. The real story, the one that should keep you up at night, is with the regional banks. This is where it gets really interesting. Regional banks often QE and compete with the big guys on a national scale for things like credit cards. So they specialize, they become experts in their local markets. And that usually means one thing: local commercial real estate. For many of these regional banks, commercial real estate isn't just a small slice of the pie, it's a huge chunk. We're talking 20, 30, even 40% of their entire loan book. That's a massive concentration of risk. It's like betting your entire life savings on one single stock. Let me give you some real-world examples. Take New York Community Bank. Earlier this year, they revealed that a staggering 44% of their loan portfolio was in commercial real estate. When investors finally woke up to this risk, the bank's stock crashed 60% in a single week. Or consider Valley National Bank with 32% exposure. Western Alliance, 28%. Zions Bank, 26%. These aren't tiny community banks. These are major institutions with tens of billions of dollars in assets. And they are all sitting on what looks like a ticking time bomb. Now, let's connect the dots. Remember March 2023? The collapse of Silicon Valley Bank sent shockwaves through the system. But here's what most people missed. SVB didn't fail because of commercial real estate. They failed because of losses on government bonds and a classic bank run. But in that same period, we saw 3 other major banks go down. Signature Bank, and then First Republic in May. That's for major bank failures in just 2 months. And the scary part, we weren't even officially in a recession. So let me ask you a question. What happens when these commercial real estate loans start defaulting, not one by one, but in waves? The regional banks with their 30 to 40% exposure will be forced to report massive, catastrophic losses. Their stock prices will plummet. And what happens when people see their bank's stock in a free fall? They panic. And when depositors panic, they do one thing. They pull their money out. This is the anatomy of a bank run. And this is the part most people don't understand about how banking works. Banks don't keep your money in a big vault in the basement. They lend it out. That's their business model. If just 20% of depositors show up on the same day demanding their cash, the bank doesn't have it. It's all tied up in loans. To get cash, they have to sell assets fast. But what if their primary assets are loans on half-empty office buildings? They can't sell them. Nobody wants to buy a loan that's about to default. The bank becomes insolvent. It fails. Now, here's the truly terrifying part. You might think, well, my deposits are insured by the FDIC up to $250,000. And you're right. But the FDIC's entire insurance fund has only about $128 billion. Remember that number we talked about earlier? $420 billion in potential losses just from a 20% default rate. If several of these large regional banks fail at the same time, the FDIC fund will be wiped out in an instant. It's simply not large enough to handle systemic crisis. So what happens then? The government steps in. The Federal Reserve prints money to bail out the depositors, just like they did in 2008. But printing trillions of dollars out of thin air has a cost, a huge cost. It means inflation. It means your money, the dollars in your savings account, loses its purchasing power. Every dollar you've saved becomes worth less. We'll circle back to that consequence. First, let's look at the specific data. I want to be clear, I am not a financial advisor, and this is not financial advice. I'm not telling you to pull your money out of any bank. I'm simply showing you the publicly available data so you can understand the risks and make your own informed decisions. Let's name names. These are banks with over 25% commercial real estate exposure based on their own public filings. New York Community Bank, 44%. Valley National Bank, 32%. Western Alliance, 28%. Zions Bank, 26%. Columbia Bank, 27%. This information isn't a secret. It's right there in their quarterly reports. It's just that most people, and even much of the financial media, aren't paying attention. If you have deposits over the $250,000 FDIC limit in any regional bank, you need to be aware of this concentration risk. Because when the defaults accelerate, it won't matter how nice your local branch manager is. The cold, hard math of the balance sheet is all that will count. But this isn't just a story about banks and wealthy building owners. This is about you, because you are connected to this chain whether you realize it or not. Who really owns all this commercial real estate? Yes, developers own some, but they borrow money, and they borrow it from banks, sure, but also from pension funds, from insurance companies, and from real estate investment trusts, which are very likely a component of your 401k or IRA. Let me trace the chain for you. Let's say you're a teacher, a firefighter, or any government employee with a pension. Your state pension fund needs to generate returns to pay for your retirement. To do that, it invests in a variety of assets. And for decades, commercial real estate has been considered a safe, stable investment. So your pension fund might own buildings directly, or it might own shares in a REIT that owns a portfolio of shopping malls, or it might own bonds that are backed by mortgages on office towers. When those properties lose value and the loans default, the losses don't just stop at the bank. They ripple outwards. The REITs your 401k is invested in will see their values collapse. The pension funds that millions of people rely on for their retirement will suffer massive write. This is how a problem in one sector of the economy can become everyone's problem. The defaults have already started. We're just in the early innings. But as more and more loans come due over the next 12 to 24 months, at today's much higher interest rates, the pressure will become immense. This is a slow motion crisis, but it's accelerating. It's crucial to stay informed and understand how these financial dominoes are lined up. Thanks for watching. If you found this breakdown valuable, make sure to like this video and subscribe to the channel for more deep dives into the economic trends that are shaping our world. Stay safe and stay informed. When commercial real estate defaults, the value of these investments collapses. Your pension fund takes losses. If the losses are large enough, your pension becomes underfunded. Many state pension funds are already underfunded by 30% to 40%. Illinois, New Jersey, Connecticut. Their pensions are severely underfunded. Now add $200 billion to $400 billion in commercial real estate losses. What happens? Either benefits get cut, or taxes get raised to fund the shortfall, or both. But it's not just pensions. Insurance companies hold commercial real estate debt. Life insurance, property insurance, the companies you pay premiums to every month. They invest that money. A significant portion goes into commercial real estate bonds because they're supposed to be safe, steady, and calming. When those bonds default, insurance companies take losses. If the losses are large enough, some insurance companies become insolvent. What happens to your policy? State insurance guarantee funds cover some of it, but not all. And here's where it cascades further. Real estate investment trusts, REITs own commercial real estate and trade on stock exchanges. Millions of Americans own REITs in their retirement accounts without even knowing it. Target date funds, balanced funds, they all hold REITs for diversification. When commercial real estate collapses, REITs collapse, your 401k takes a hit. Now, let me show you the scale. Banks, $2.1 trillion in CRE loans, pension funds, $500 billion in CRE investments. Insurance companies, $300 billion in CRE bonds, REITs, $400 billion in market cap total exposure, over $3 trillion, and that's just direct exposure. Indirect exposure is even larger. When commercial real estate collapses, property values fall. Property tax revenues fall. Cities and states have budget shortfalls. They cut services, lay off workers, raise taxes. Businesses that service commercial real estate, construction companies, maintenance firms, property managers, they lose contracts, they lay off workers, unemployment rises, consumer spending falls, the economy slows, and we haven't even had the recession yet that everyone's predicting. Let me ask you this. What happens when commercial real estate collapses, regional banks fail, and we enter a recession at the same time? Stay with me, because this is where the pattern from 2008 repeats. 2008 started with subprime mortgages, the housing market. Everyone remembers the foreclosures, the bank failures, the bailouts. But let me show you the timeline, because the pattern is repeating. 2006, housing prices peak. Nobody sees the problem yet. 2007, defaults start rising. A few hedge funds collapse. Bear Stearns has problems. But mainstream media says it's contained. Early 2008, bear. Stearns collapses in March. Gets bought by JP Morgan in a fire sale. September 2008, Lehman Brothers collapses. The crisis goes global. Stock market crashes 50%. From peak to crisis, 24 months. Now let's look at commercial real estate today. 2022, interest rates start rising, but buildings are still full. Nobody sees the problem yet. 2023, return to office fails. Vacancy rates rise, a few defaults start. Silicon Valley Bank collapses, but it's blamed on bonds, not real estate. Media says commercial real estate problems are isolated. 2024, major defaults begin. Brookfield walks away. Other firms follow. Regional banks report losses. 2025, we are here. $2.1 trillion in loans maturing, refinancing impossible. If the pattern holds, crisis goes full scale in 2026 to 2027. But here's what's different this time. In 2008, the Federal Reserve could cut interest rates to zero and bail out the system. They had room to maneuver. Today, the Fed is stuck. Interest rates are 5.5%. If they cut to zero to save commercial real estate, inflation explodes again. If they keep rates high, commercial real estate collapses and banks fail. They're trapped between inflation and deflation, between saving the currency and saving the banks. And here's the brutal truth. They'll choose the currency. What does that mean? It means they'll let commercial real estate collapse, let regional banks fail, let the FDIC step in. They'll bail out depositors, but not investors, not shareholders, not bonds. If you own stock in a regional bank with heavy commercial real estate exposure, that stock could go to zero. If you own bonds backed by commercial real estate, those bonds could default. This is what happened in 2008. Bear Stearns shareholders got $1 per share when the stock had been trading at $172. Lehman Brothers shareholders got nothing, zero. Washington Mutual, the largest bank failure in U.S. history at the time, shareholders wiped out completely. The same pattern will play out with commercial real estate. Building owners will be wiped out. Bank shareholders will be wiped out. Bondholders will take massive losses. But depositors will be protected eventually after panic and chaos. And the cost of that protection, printed money, inflation, devaluation of the dollar. Let me show you exactly what I mean. So here's the timeline as I see it unfolding. 2025 through 2026, defaults accelerate. Every quarter, more buildings are handed back to banks. Every quarter, more regional banks report losses. The media will cover each one as an isolated incident. This bank had unique problems. That building was poorly managed. They'll miss the systemic pattern. Mid-2026, a major regional bank fails, larger than Silicon Valley Bank, deposits over $100 billion. The FDIC steps in. Depositors are made whole, but it drains a huge portion of the insurance fund. Markets panic. Other regional bank stocks collapse. Depositors start withdrawing money even from healthy banks. Late 2026 or early 2027. Multiple bank failures in quick succession. The FDIC fund runs dry. The federal government announces an emergency support program, unlimited deposit insurance, backed by the Treasury, which means backed by printed money. The Fed and Treasury creates $500 billion to $1 trillion in new money to backstop the banking system. This stabilizes the banks, stops the panic, prevents a complete collapse. But it has a cost. The dollar weakens, inflation returns, not 2021 levels, but 6% to 8% annual inflation for several years. Your savings lose purchasing power, not through a stock market crash, through currency. This is the hidden cost of saving the system. They don't let the banks collapse completely. They print money to prevent systemic failure. But printing money transfers wealth from savers to debtors, from the middle class to the government. It's a bailout funded by inflation. And here's what makes this different from 2008. In 2008, housing recovered. By 2020, housing prices were higher than 2006. If you held through the crash, you eventually recovered. But commercial real estate is different. Work from home is permanent. Office demand has structurally fallen. Even after the crisis, even after defaults are cleared, office buildings won't return to 2019 occupancy levels. Some buildings will be converted to apartments, some will be demolished, but many will remain vacant or underutilized for a decade. This isn't a cyclical downturn. It's a structural change. That means the recovery won't be it'll be L-shaped. Property values stay depressed for years. Banks remain cautious about lending. Commercial real estate investment stays subdued. The knock-on effects last throughout the rest of the decade. Now, let me show you what you can do about this. Let me give you 3 specific things to focus on. First, know where your money is. If you have more than $250,000 in any single bank, especially a regional bank, understand that only $250,000 is FDIC insured. You have 3 options. Spread money across multiple banks to stay under the insurance limit. Move money to the largest banks, JP Morgan, Bank of America, which are too big to fail and more diversified. Or move money into Treasury bills directly, which are backed by the full faith of the US government. I'm not telling you to panic. I'm telling you to know your exposure. Second, check your investment accounts. If you own REITs, if you have commercial real estate exposure in your retirement account, understand the risk. You don't have to sell everything, but maybe reduce exposure, rebalance toward less commercial real estate. Look at your target date funds. Look at your balanced funds. See what percentages in REITs. If it's over 10%, consider rebalance. Third, watch the indicators. Watch for increasing bank failures. Watch for rising defaults. Watch for FDIC interventions. These are the signals that the crisis is accelerating. And if you see those signals, act before everyone else does. Because by the time it's on the front page of every newspaper, it's too late. Let me be very clear about what I'm not saying. I'm not saying sell everything and hide cash under your mattress. I'm not saying the entire financial system will collapse. I'm not saying America is doomed. What I am saying is this. There's $2.1 trillion in commercial real estate debt maturing between now and 2027. Much of it cannot be refinanced at current interest rates and occupancy levels. Defaults are inevitable, not possible, inevitable. The math doesn't work. Regional banks with heavy commercial real estate exposure are at risk. The cascade effects will hit pensions, insurance companies, and retirement accounts. The government will intervene. They'll print money to prevent total collapse. But that intervention has a cost. Inflation, currency, debate, loss of purchasing power. The people who see this early position themselves accordingly. They diversify. They reduce exposure. They hold assets that maintain value through inflation. The people who don't see it, or who see it but don't act, they're the liquidity. They're the ones whose wealth gets transferred. History shows this pattern over and over. There's Muyoit, the people who saw the subprime crisis early. Michael Burry, John Paulson, they made billions. The people who didn't see it lost trillions. This time, the pattern is commercial real estate. The timeline is 2025 to 2027, And the question is whether you see it before it's obvious to everyone. The commercial real estate collapse is not a prediction. It's math. $2.1 trillion in debt. Interest rates tripled. Occupancy rates halved. The defaults have already started. Brookfield in 2024 was just the beginning. The bank failures are coming. The cascade through pensions and insurance companies is coming. And the government intervention, the money printing, the inflation, that's coming too. The only question is whether you position yourself before the cascade or during it. Because during it, there's panic. There's chaos. There are bank runs and frozen accounts and emergency measures. Before it, there's clarity. There's time. There's the ability to act rationally. We are in the before window right now. We're in 2007, watching the first cracks appear, while everyone else says it's contained. The people who act now will look prescient in 2027. The people who don't will ask why nobody warned them. Consider yourself warned. This is educational content, not financial advice. I'm not a financial advisor. I'm showing you data, patterns, and historical parallels. What you do with that information is your decision. But the math is clear. The timeline is clear. And the pattern from 2008 is repeating. Commercial real estate, regional banks, government bailout, currency debasement. It's playing out right now, and the next 24 months will determine who saw it coming and who didn't. If this breakdown changed how you see commercial real estate, regional banks, and what's coming over the next 2 years, I need you to do something. Subscribe to this channel, because this is just one piece of a much larger puzzle. The commercial real estate collapse doesn't happen in isolation. It's connected to the dollar losing reserve currency status. It's connected to government debt. It's connected to the Bitcoin strategic reserve. It's all part of the same pattern. In my next video, I am going to show you how the US government plans to use Bitcoin revaluation to erase $37 trillion in debt, and how that connects directly to this commercial real estate crisis. Because when banks fail and the government has to print $1 trillion to bail them out, where does that money come from? It's not magic. There's a mechanism, and that mechanism involves Bitcoin, gold, and the strategic debasement of the dollar. If you want to understand the complete picture, subscribe now. Hit the notification bell so you don't miss it. And if this video was valuable, if you learned something you didn't know before, leave a like. It tells YouTube to show this to more people, because most people have no idea this is happening. They think everything is fine. They think their money is safe. They think 2008 can't happen again. But you know better now. You've seen the data. You've seen the pattern. You've seen the timeline. $2.1 trillion in commercial real estate debt maturing now. Defaults inevitable. Regional banks at risk. Cascade effects coming. Government bailout through inflation. The people who position themselves now will preserve their wealth. The people who don't will watch it evaporate through inflation, bank failures, and pension cuts. Choose what. Subscribe if you want to track this as it unfolds. I'll see you in the next one.